Good evening, everyone, and welcome to the Confluence Investor Meet hosted by ICICI Prudential AMC. It gives me immense pleasure to engage with all our investors across multiple cities this evening. Year 2020 and 21 has shown us a unilateral direction of markets. However, ever since 2022 started, we have only woken up to some eventful headlines. Events at play have been like the central bank tightening, absolute divergent views on oil prices, FI selling, to name a few. Amidst all this, we thought that it's a great time to connect with our investors and present our thoughts. To take this discussion forward, we have with us a set of panelists today. It takes me immense pleasure to introduce Mr. Nimesh Shah, MD and CEO, ICICI Prudential AMC, Mr. Manish Banthia, Senior Fund Manager, Fixed Income at ICICI Pru AMC, and Mr. Chintan Haria, Head Product Development and Strategy at ICICI Pru AMC. Once our panelists are done with their talk, we will open the floor for Q&A. So let me please bring in Mr. Nimesh Shah. Nimesh, over to you, please.
Good evening, everybody. It's a tremendous pleasure to talk to customers as always. People who have invested us, shown their confidence on us. So I'm Nimesh. I work with the ICICI Group since last 3 decades, and since last 15 years, I am CEO of ICICI Prudential Mutual Fund. Mutual fund in India have got a tremendous governance structure. The way normally people report, a CEO reports into one board. Right, in the mutual fund structure, you report into 2 boards. There is a AMC board, which is like any other company board, which looks after the affairs of the company. But the specialization in mutual funds is there is a trustee board. What does the trustee board do? So we have got very eminent people sitting on the trustee board. So what is their primary duty? There is already an AMC board. Why is there a trustee board also? So trustee board is there to take the trustee board orientation is to take care of the investor's interest. Right? Whether ICICI Prudential Mutual Fund, we as AMC, asset management company, are taking care of our customers' interests. The trustee board is continuously monitoring that. What is the risk that we are taking? How much risk we are taking in generating the returns that we are generating? Whether we are following all SEBI regulations or not. So it's a very, very robust governance structure that the country follows on governance of mutual fund. And I believe that over the last 15 years, SEBI has done a tremendous job of governing mutual funds, right? Regulating mutual funds, I would say. And I think we have done a very good job where it's become a very good product, not only of ICICI Prudential. Overall, AMC industry is a very good product. Mutual fund is a very good product where it's a very transparent product. You exactly know what you are getting when you see in the fact sheet at the end of the month. You know if you have given us 100 rupees or 1000 rupees, how has that money been invested? So it's a very transparent product. The charges are very transparent and are quite reasonable or quite less. And it's in India, we have understood that very clearly that the charges will keep on coming down. So this is one business that last 15 years, the margins are continuously coming down, but still it is doing well for the customers also. There is a complete alignment of interest between the customer, between the distributor, between us, everybody. So I think the product is powerful because the interests are completely aligned. So what we do at ICICI Prudential is what I do at ICICI Prudential or what the company does. There is a perception that you need to, how we manage money. First principle of money management should be that you try and minimize your losses ever. So risk management is the most important thing in an AMC as to how do we control risk. It is not possible to generate without returns, without taking risk. But how is that risk managed is extremely important, and that is the function that I directly oversee. And I'm very happy the way we have managed risk over a period of time, because there are 2 ways of making money. I've always understood. One is that when the market goes up, you go up more than the market. So if the market goes up 15%, the endeavor of the fund manager is to go up 18%. That is one way of managing money. Another way of managing money is that when the market goes down 10%, you go down only 4%. If we are relative return givers, right? We are not absolute return givers. So we are not saying that 1 year down the line will give you so much return or something like that. We are saying what is our endeavor? Our endeavor is that we want to somehow give you a better return than what the benchmark returns are. right? What the Nifty returns are. If my fund is target benchmark is Nifty, then I should give something more than Nifty. That is always our endeavor. So we are always relative return givers. So in that relative return, two ways of making money. Either you make money on the upside when the market goes up, or you always lose less money. So if the number of days that the market goes down nowadays we are seeing is more or less equal to the number of days the market goes up, then it might be a much smarter thing in life to do to manage money in a way that you lose less than the market. Right? When you lose less than the market, and number of days, if the market goes up and goes down is equal, then your probability of making money, risk-adjusted return for the customer is much better if you are beating the market on the downside rather than trying to beat market on the upside. So at ICICI Prudential, we have done that quite well over the years. Now it is not 1 year, 2 years, 3 years. This company has been in existence since last 24 years. And since last 24 years, we have been able to demonstrate that the risk-adjusted return, we never try to give you absolute return. We always try to give you risk-adjusted return. And by following the principle of, so if you see our fund manager, we are always there on television. My CIO, my fund managers are always there on TV on the day the market falls dramatically. Or if there is a huge fall in the market, we are the first ones to come on TV and tell people that is it a what kind of fall it is, what it has resulted in, because we tend to do very well in those times. So over a period of time, I believe that if you have got that style, risk-adjusted return is much better. It is very important to understand this element of risk that the fund is taking, and for us, that is extremely important. One of the things that I have not been successful in the last 15 years is to convince the common man of India that he need not invest in a fund which has done very well in the last 1 year, 3 years, right? Normally people sort, right? And this data is coming out more clearly as more and more digital channels are coming in. When we see that when we look at a digital channel, everything is transparent in a digital channel. You can clearly see what did they sort out before deciding and selecting a fund, what did they select? So when we ask the digital partners as to what did the customer select before he came onto and select and bought our fund, invariably it comes out that people selected what did well for the last 1 year or 3 years. I think that if we can somewhere, and I am saying that when our funds have done very well, you would have seen an article in Economic Times today which talked about why ICICI Prudential funds have done very well, etc. That is what it has come down on ET now today. So I was when you look at closely at it, that if on a consistent basis people keep on tracking, my whole problem is that I am saying this when I am saying that do not look at only past returns and come into mutual funds. I am saying it when my numbers are very good. I'm not saying it that otherwise people will think that my numbers are not good, so that's why I'm saying. When our ICICI Prudential numbers are very good, I'm saying don't give us money only because last 1 year or 3 years our performance has been very good. Invariably, the retail customer is looking at that data and coming into it. There is a huge probability of selecting the wrong fund because of that. So I would always urge people that please invest with ICICI Prudential, but do not invest just because our last 1-3 years returns have been very good. Past return is only an indicator. In India, people take it as complete truth and people follow that. But I would also say that past return is also only an indicator that we are managing the money properly. One has to see, one has to take judgment on the people, and events like this. I'm very happy that ICICI Prudential has organized this event where you will have to take a judgment on us when you look at, when you are meeting us, when you are hearing our fund managers talk. You'll have to take a judgment. It's all about judgment and how will, because just because a fund has done well in the last 1 or 3 years, it does not mean that it will do well for the next 3 years. Right? There are various styles of fund management. There are various phases of the market. Like till 2020, quality at any price did very well. Right? After 2020, value funds started doing very well. So, if you were invested in a fund called ICICI Prudential Discovery Fund or ICICI Prudential Opportunities Fund, they are the funds which would take special situations, or they will take a value investing. They believe in value investing and they would have invested in value stocks. Whatever the fund manager would have done, however good stock selector he would be, in 2020, 18, 19, 20, it was not possible for him to make good return because market was valuing only 10 stocks well. Only 10 stocks. Still, if you see between 2018 and 20, only 10 stocks were doing well. Mutual funds by nature are diversified. But if there is a Nifty 50, we would have invested in 30 stocks in that. But markets was rewarding only 10 stocks. So some people who would run very concentrated portfolio can lead to higher risk, right? But somebody who was managing concentrated portfolio could have done very well, and that value fund would not have done well. So in 2020, 19, we saw a lot of people redeemed out of a value fund. Right? What happened in 2021? That value fund skyrocketed. Right? The returns came out very well in 2021-22. So people who saw past performance and redeemed out of a fund actually lost out because they were not present when the value stock started doing very well. So what do? We manage around almost 4,80,000 crores. We manage around 4,80,000 crores. So we have divided into various buckets. Right? We have got various kinds of funds. So we have got a lot of funds only to ensure that we divide our funds into various buckets and then give it to different fund managers. I know the endeavor is that over a business cycle, all the funds should do well. We want every fund to do well. Like the CEO of ICICI Bank, who always tells me that अपने भाई को जो दे सकते हैं वो product दीजिए आप. Right? अपने भाई को दे सकते हैं. But I always tell him that my entire 4,80,000 crores can be given to our brother. Right? That's the kind of, because we have divided all this into various funds. In a period till 2020, one kind of funds would have done well, because quality fund manager who had invested in quality stocks, a fund would have done well. Beyond 2020, maybe another set of funds will do well. The endeavor is that over a business cycle of say 7 years, 5 to 7 years, all our funds should do well. That's what our endeavor has always been. Right? So we stick to what if we have told you that it is a value strategy, we will stick to value strategy. Even if the value strategy does not do well, we'll stick to that strategy and try to, because we know that there are phases of market where there can be underperformance. In fact, I would say sometimes that a good fund manager is always supposed to underperform initially, because he's supposed to take a call before the market takes the call. So it will take time for him to come right. So in equity, my strong advice to everybody is that do not invest with less than 3-year paradigm. Right? It should be ideally 5-year plus paradigm that you should invest in equity, because equity you are investing in somebody's business, and business takes a business cycle to do well. So unless you have a 5 to 7-year paradigm, you should not be investing in equity funds. And we can deliver a good investor experience only if you give us time of 5 to 7 years. Otherwise, it is difficult to deliver consistency. So what we have done, we have divided 4,80,000 crores into various funds. Those funds have been given to various fund managers. So frankly, at every 30-foot in, we have almost 2,40,000 crores of equity in ICICI. We manage equity funds of almost 2,40,000 crores. So we have divided into various 7 or 8 fund managers. Right? We have got around 7 to 8 fund managers where we have divided our AUM into various people, and they are the ones who are managing it. So one thing that I can assure you, that 100% of my money is also invested in ICICI Prudential. My returns are very important to me. And people ask me, when I say that 100% of my money is invested in ICICI Prudential, people ask me, don't you want diversification? That is a word that somewhere a lot of people have read this jargon called diversification. Yes, diversification is important. But if you invest only in one fund, I have always had this question that if you invest only in one fund, say you invest in ICICI Prudential Blue Chip Fund, don't you get diversification? Because one single mutual fund by definition is diversification, because one single mutual fund will invest almost in 40 different stocks, 30 different stocks. So 30 to 40 different stocks a single mutual fund will invest. Is it not diversification? Now you say that I want to diversify amongst various fund houses. Then you diversify amongst various funds within that fund houses. So everybody will have 4 fund houses, and after 4 fund houses, if they have got 5 different funds of that fund house, you end up having some 20 funds. Right? What happens? Actually, you do not get the benefit of active fund management because of that, because ultimately everything gets averaged out. So if you buy 4 or 5 different funds, ultimately we have seen you are buying almost the index. Then what is the point in buying an active fund? You can as well buy a passive fund. So we have consistently seen that people who over diversify, mutual fund itself is a diversification. Please look at your portfolio or this one as to how much one should diversify. over diversification is become, when I'm seeing a lot of friends and families portfolio, so over diversification is a problem. So somewhere when people ask me, you're not worried, you're not diversified, I'm very comfortable. It is very important which asset class you have put money in, right? It is not which fund you have put money in. If you have invested equity and you have stayed for a long period of time, you have tended to, and you have been consistent in what you have been doing as per your asset allocation model, then it makes sense rather than trying to diversify too much. That is another thing that I have seen. Another that I have seen, somewhere people relate mutual fund means equity. The biggest asset class in India, and if this debt, and please do not ignore that. Debt mutual funds are very important. We have been managing debt since last 24 years. Another thing that I wanted to say is that we are heavily invested into the alternates. People want to see their portfolio. Mutual fund is you are investing in a fund, and we are in turn investing in a, you are investing in a mutual fund, you get the same. But if you want us to manage your individual portfolio, Chintan has created a huge force of people who are managing portfolios for you. So if you have got a direct portfolio, we are happy to take over your portfolio, right? That is our endeavor always in trying to give you a risk-adjusted return. On the PMS side, we have also got alternative investment funds. This PMS and AIF vehicle, if you are game for, if you want to take more risk, and with the hope of getting more return, we have those concentrated portfolio, because mutual funds are by nature, as I said, would be very diversified instrument. But if you want a concentrated portfolio, we can help you in our alternate investment business, which is AIF, PMS, where we would can help you in creating alternative portfolios. We also have something called as long short fund. So we have created a variety of products you can on our alternate space. So whatever ICICI Prudential does, we are very clear that we have to manage your risk well. A trustee board is supervising us all the time, whether we are working in the interest of our investors, and that is ingrained in us. Because I say I've just come, I'm wearing this orange color thing because I've come for a social function somewhere. And 90% of the people right now I meet, whenever I go in a social function in Bombay, most of the people I meet would be invariably, if I go for a marriage, out of the 100 people I meet, 90 will be my investors. So it is very important for me that my fund does well, because not only my professional life, even for my personal life, it is very important because most of the people that I know are invested in ICICI Prudential Mutual Fund. So it is not only important for my professional life, it is very important for my personal life that your investments are well taken care of. So thank you all, and we will. I'll hand it over to Chintan, and Chintan can take you through what we do on the equity side.
So we'll request Manish to speak first, and then I'll take up.
Okay. Sorry.
Then,
Manish has been handling our debt portfolio for a long time, and whatever I have said, so Manish has done a fantastic job for us for almost more than 15 years now. Manish, hand it over to you, and please convince people it is very important to understand in debt as it is important to understand in investment in equity.
Thanks, Nimesh. A very good evening to all of you. It's a pleasure to connect to so many people at the same time. I think there's a beautiful endeavor taken by Komal and team. I'm going to talk for the next 15-20 minutes on an asset class, which I think is very exciting. And, while people think that fixed income is a asset class which is boring and complicated. I think that next 15-20 minutes, I would make sure that I make it as simple as possible for all of you and as exciting for all of you. So I have a presentation for all of you. Let me share that presentation. So I'm going to talk about why debt is very important in your portfolio, and particularly at this point of time, why it makes a lot of sense to look at debt from a different angle. But before talking about it, let me talk about asset allocation. Let me talk about why debt is so important in part of each and every portfolio. So my first slide is not on debt, it's on equity. And if you look at this chart, it's a chart of Sensex. What I've done is I've pulled out the chart of Sensex from 1988 to where we are right now. And while it would look a little different from what you look on your screen every day, what I've done here is I've done a log of the returns. Effectively, it means that it gives you exactly what kind of trajectory in terms of percentage returns the market has given. So what is clearly visible is equity does well in periods of time, and there are periods of time when equity is kind of flattish. So this period from 1988 to 1994 was an excellent period in equity. But what followed after that was from 1994 to 2001, you had 7 years where the CAGR return was 3.1%. Then again from 2001 to 2007, you had a great run in equity. But after that, somebody who had invested in 2007, the next 6 years had a CAGR return of minus 1.4. Then again from 2014 to 2021, you had a great run, another 7 years. Now what lies ahead is something which we can all think about. But my point is that as an asset class, if you want a consistent earning, you can invest in equity for 10 years, 15 years, but there will be periods of time when you may not get what you want to achieve in terms of your income growth. Again, the next chart, it is not about fixed income, it's about gold. This chart is about INR gold in rupee terms, and this chart is from 1975. And again, this is a chart which is in terms of log. And again, gold as an asset class has given very good returns in periods of time, but there have been periods of time where it has frustrated as an investment. So I don't know whether I should talk about 80s, but a recent memory is from 2013 to 2000, almost 2019, gold was almost flat, and it frustrated investors for a long period of time. And after 2019, it started to move up again. The idea is that if you would have invested in gold at the wrong time, there can be periods of 5 years, 7 years where there would be no returns on this asset class. The third asset class, again, not fixed income. I have been talking about fixed income, 3 slides, no slides on fixed income. This is on real estate, an asset class where people like to invest, but again, it's cyclical in nature. If people who would have seen history would remember that 1995 to 2003 was a period of time when real estate as an asset class was almost flat to negative. There were no returns. And more recently, from 2012 onwards to 2020, again, this asset class underdelivered. People were very excited in 2012. They were over invested in this asset class. And for the next 8 years, people did not make any money on this asset class. So that is what I think makes debt very exciting, because the next slide, the slide which I'm going to talk about, is the slide on debt. And you will not get a period in debt where you will not get returns. So that is beauty of fixed income. And this is the reason why I feel that debt as an asset class should form a part of your portfolio at all points of time. Because when you feel that you will enter a flat period in other asset classes, you will need income generation in your portfolio. And if you do not have fixed income in your portfolio, you will not get those returns. So this is a simple depiction of returns of, or rather index of crystal short-term bond index. It's a, I could have shown funds as well, but because of regulations, I'm showing this index. This index has given almost steady returns from 2002 to 2022. And there have been no drawdowns, major drawdowns in between. So clearly this means that somebody who would have invested in debt, it's like a tortoise. The tortoise would move slower than the hare, but the tortoise will be more steady. And debt is a tortoise in your portfolio. So therefore, keep hares in the portfolio, but don't forget about tortoises. I'll try and make this chart simple. I know it is complicated, but Nimesh talked about past returns. And he said that past returns should not be looked at to make future decisions. Now, when we talk about fixed income, the interest rate, we know that there are times when RBI is increasing interest rates. There are times when RBI is cutting interest rates. So interest rate moves in cycles. You would have seen FD rates. FD rates, sometimes are at 8%, 9%. Sometimes FD rates are as low as 5%, 4%, 3%. But the important point is that they go down, then they go up. RBI takes down repo rates. RBI moves up repo rates. What I'm going to show in this chart is this blue line, which moves down, then goes up, then goes down, then goes up, then again goes down, then goes up, and then again goes down. So this is a 1-year return on again that index I had shown, CRISIL short-term bond index. And you would observe that there are periods of time when this index has given very low returns. I mean, between 9 and 11, the past 1 year return was low. Again, in 2013, the past 1 year return was low. In 17-18, the past 1 year return was low. And again, we have achieved a period right now where the past return is very low. The point is, investors, when they look at past returns, they feel that the asset class should not be invested in. And normally we've seen that when past returns are bad is when investors take out money from that asset class. Because people feel that what has happened in the past is going to continue in the future. If my past returns on this short-term bond index is only 3%, why should I be invested in this fund? I should be invested in something else where I get a higher return. 3% is too low for me. But the point what I'm trying to make is the red line. The red line is the 3-year return, which people have gained when they have invested in this period, when the past returns have been very low. So in July 2010, while the past 1 year return was very bad, if you would have invested in this segment, your return would have been higher than 8%. Look at this again. When your past 1 year return has been low, the next 3-year return has been very high. Again in 2018, the past 1 year return has been very low. And look at what the next 3-year returns has been. Now we have this period where past 1 year return is low. And what I'm trying to say is, if the past 1 year return is low, my expected 3-year return has to be higher. And I'll tell you why. It is very simple. My returns are low right now because RBI has increased interest rates. And in case of fixed income, I'll just tell you how the total return is divided. Your total return comes from two segments. One is an accrual income, which is a coupon which you accrue on your income. Say, for example, a bond trades at a coupon of 7%. Now it will regularly give me a coupon of 7% every year. When the yield in the market or the interest rates in the market, they go down, I get some capital appreciation as well. So it's a simple maths. If you are at 7% right now, and if yield go to 6%, if I am going to buy a new bond in the market, it is only going to fetch me a 6% yield. So a 7% instrument should be more valuable because that is giving me a higher coupon. So I will sell that or buy that at a higher price. So 100 rupees instrument will trade at 102 or 103. Because the other instrument which is available at 100 right now is only going to give me 6%. So somebody who was invested in the 7% instrument earlier now has returns, two returns. One is he's getting a 7% coupon, plus he's getting that premium on his bond. And that premium is capital appreciation, what we have over here. So when interest rates are falling, your RBI cuts interest rates. So in those periods of time, your capital appreciation part is very large because your returns are getting upfronted. What I mean by returns getting upfronted, very simple. You have a 7% coupon bond and RBI rates go to 5%. So while I have a 7% bond, but my alternate investment, if I have to sell this and buy a new bond at 100 rupees, I will only get a 5% return. So my 7% bond is now valued at 105 or 107. So I have got a 5 to 7 rupees extra on that bond, plus I'm getting a coupon. So my returns look very, very high. In a falling interest rate scenario, capital appreciation is the bigger part of the return. Now, what happens when interest rates rise? When interest rates rise, the capital appreciation part is either very small or at times also becomes negative. Whereas the accrual part continues to give you returns. And which is where I'll go back to the slide where I have shown a 1 year return. Now this 1 year return has been low because interest rates have been rising. And when interest rates rise, my capital appreciation becomes capital depreciation. The capital value becomes negative. But the good part is that the new coupon which I'm getting now is pretty high. Effectively meaning that what I used to get as 5% a year or 2 years back when RBI interest rates were low, now I'm getting 7%. So since I'm getting 7%, my YTM on the portfolio that moves up. And therefore, because my YTMs are high right now, my expected return for the next 3 years are going to be much higher. This period, the 1 year return was low, but do you know what is the kind of YTMs fund had at this point of time? The YTM had gone up to 9% or 8%. Again, in 2013, RBI hiked rates by 300 basis points. We know that that was a time when the rupee also went into crisis. But the YTM went up. The YTM was 8% or more than that. In 2018, again, RBI hiked interest rates. The YTM went up and the YTMs were closer to 7-8% or more than that. And again, at this point of time, RBI has been hiking interest rates. And because of that, YTMs are now higher than 7.5%. So effectively, don't look at the past returns to look at what you'll earn on the fixed income asset class. Look at the YTM of the fund. At this point of time, it is important to concentrate on YTM because we are in a cycle where your maximum returns are going to come from the accrual income. RBI has hiked rates. RBI will hike rates a little more, but markets have already been discounting that. And therefore, we have achieved a period where in the next phase of fixed income cycle, YTM is going to make the maximum return for you. So therefore, don't look at the past returns, look at YTMs, and therefore YTMs will show you what kind of returns can you expect in the future, not the past returns. We're doing some, some exercise on fixed income. I think it's very different. You not have seen this, done anywhere else in the country. This is called the valuation of fixed income. The valuation of fixed income is important because we've seen it in equity. When markets are expensive, you choose a particular strategy. When markets are cheap, you choose another strategy. The same is in fixed income. What we have done is we publish this chart every month on the fact sheet. And what we've done is we give what kind of duration strategy should an investor run. There have been periods of time in 2014, 15, 16 when the valuations were very cheap. So effectively, investors were advised to run very high duration on their portfolios. In 2018, we achieved a point where we thought that market is expensive and therefore valuations or the products to be selected should be low duration. And then the market moved to a moderate duration. Look at this. The last 2 years, interest rates have been very low and we've been very cautious in terms of our commentary to our investors. The commentary all through the last 2-3 years have been fixed income is in a cautious zone. People should be cautious about returns on fixed income. And therefore, the past 1 year has not been great in terms of returns. But the good thing is market has moved up now. And therefore, the prospects look much better than what they have looked in the past. This is something I think you should watch, you should read. Every month, we publish it on our fact sheet. And this is a product of our internal, models which we work on. Another interesting aspect of fixed income I wanted to discuss was, and I think this is something which is very exciting at this point of time, is floating interest rate. Very interesting concept, but I think to understand, one should look internally in terms of their decisions, what they take when they take loans. And housing loan is something which a large part of population takes because people buy houses, they buy houses on loans, and they have to give or they have to bear the cost of EMIs. And how do you select a housing loan? Very simple. When you think that interest rates ahead are going to come down or are going to remain steady, you think that the best way to take a housing loan is to take a floating rate loan. Because if interest rates are going to come down, every time the interest rate goes down, you will benefit. I'll put it the other way. What if people would believe that interest rates are going up, which is happening right now? Would you choose a housing loan which has a floating rate? I think people have chosen that, but people would have realized every single rate increase by RBI has increased their cost on the housing loan. And going back, people would have thought, why did I not choose a fixed rate housing loan? Because interest rate increase is a cost to people. But what if I'll tell you that rather than a cost, if it is an income, would you choose a fixed rate or a housing loan? Simple. There are instruments called floating rate bonds, which do the same thing for you in terms of investment. There are fixed rate bonds which have a fixed coupon. For example, Government of India 2031 security. In September 2021, government issued this security. It was at a coupon of 6.1%. It's been almost 9 months. The coupon has not changed because it was a fixed rate bond. If you had invested in this bond, your coupon income would have remained flat. But think about it. It was a time when interest rates were very low. There are other kind of bonds called floating rate bonds. And what are these instruments? These instruments are linked to RBI repo rate or treasury bills. So this instrument particularly, if I look at the return trajectory, it was issued at a coupon of 4.6%. The coupon looked very low. Why should anybody look at a low coupon? Why should invest in a 4.6% bond? But the beauty of this product was that the coupon was not fixed. It was to increase with change in RBI rates. And think about it, RBI's overnight rate was at 3 to 3.5%. And I don't think that they would have remained where they were. The next coupon or the next reset which happened, April 22, you got a coupon of 5.5%. RBI hiked interest rates in this period and is now in the process of hiking more. And look at the next coupon which you're getting, 6.9. So very simple. When you think that you are in a cycle where interest rates are going to move up, I think the better product for you to choose is a floating rate bond. And till the question normally comes till when you are excited to invest in this product. The answer is again very simple. Till the point you don't think RBI will start to cut interest rates. And I don't think we are in a cycle right now where for the next 2 years or next 2.5 years, RBI is going to cut interest rates. We can argue how much more interest rates can be hiked. Our view is that RBI will hike another 75 to 100 basis points of interest rates in the next 2 to 3 policies and possibly may stop there. But possibly again after a year or 2 years time, the interest rates may be hiked again as we reach a better growth, a better part of the economic cycle where RBI will have to tighten more. So therefore, till the point you're not worried about rate cuts, I think this product will do very well. And therefore, we recommend this strategy as a part of your portfolio right now. The other thing which I wanted to engage with you was the credit risk fund. Nimesh talked a lot about our risk management, and I resonate completely with what Nimesh has said. Back in 2020, or rather back in 2017 and 18 were periods of time when people only talked about YTMs. We felt at that point of time that risk management was more important and people should look at risk adjusted returns. And for that period between 2018, 19, 20 and 21, we only looked at risk management because we thought that if we can manage risk in this period of time, the trust which investors will have on us will be much more. And people have seen over this cycle and over a period of time as an organization how we have managed risk in different parts of the cycle. We've seen cycles and therefore, the risk management becomes complete if you've seen cycles. But the good part about this product is over the last 1 year, the absolute YTMs of the products were low because RBI interest rates were also lower. But the good part is that the YTMs on this product are now increasing. This is the published YTM on June 22. And the good part is that this YTM, because RBI is going to hike more in terms of interest rates, these YTMs are only going to improve. And as I said in the earlier part of my presentation, the maximum part of return in this cycle from here is going to come through accrual income. So higher the YTM, the higher the returns would be. So we feel that in this part of the cycle for the next 3 years, credit risk funds will make a lot of sense for investors. And when you have periods of time when other asset classes may remain volatile or flat, so we feel that investors should look at this category of funds. So just to summarize what I have said, debt is a very important asset class in your portfolio. While it may look cyclical, but the cyclicality is much less. There are very low periods of time of drawdowns, and normally over a period of time, it gives steady return to your portfolio. Near-term returns on debt is not what we expect in the future. In fact, it's the opposite. When your near-term returns are bad, your future returns become more exciting. So since the near-term returns right now look very ugly, I think the next 3-year returns are going to be very good for fixed income. Fixed rate instruments have two components, capital appreciation and accrual income. People should concentrate on accrual income at this point of time. And people should focus on the YTMs on their portfolios. Please look at YTMs. Going forward, accrual income is expected to be the main driver of returns. We recommend two strategies at this point of time. One is credit risk strategy, and the other is the floating rate strategy. Please go through details on the products. These product details are available at the website. The presentations are available. Please go through them. And we think that we will be there for you to explain fixed income again and again. It's a very simple asset class. Please don't complicate it. And I think it's my job right now and job in the future to help this asset class become as simple for you to invest as I can. Thanks a lot. I will now hand it over to Chintan to talk about equities. Thank you.
Thanks, Manish. I think Nimesh and Manish both have covered very well how we at ICICI Pru manage each rupee that we have, that y'all have entrusted upon us, and how our risk measures as well as how we've been able to, manage the money in the right earnest. On debt, of course, Manish has covered whatever is happening, and I think in the next 10 minutes or so, I'm cognizant of the fact that we are probably running about 5 to 7 minutes over time. So in the next 15 minutes, I'll try and cover the equity story along with gold and silver, and then we'll open it up for Q&A quickly, and then we can wrap it up. So over the last maybe 3-4 years, we've seen interest rates going to negative territory in the world, which Manish would probably have not expected when he started his career. We started our career almost together 15-17 years back, and I don't think we had probably budgeted for a negative interest world ever. What happened in the negative interest rate world was that asset classes, because money became cheap and money was available aplenty, all asset classes started to become expensive. And we saw a huge equity rally, especially after the pandemic, where to save the economies from getting hurt with the pandemic, almost all the central banks launched their own schemes to print more money. And that led to, across the board, agri-commodities, base metals, equities, real estate and developed markets, even bond prices, everything went up. So it was like a concerted effort wherein the money printed led to all asset classes going up at the same time. Now, as things happen, mean reversion, we at ICICI Prudential are very much believers of mean reversion. And when interest rates went to negative, they couldn't have been negative for a long period of time in the economies like Europe. And so it had to mean revert and interest rates had to go up, which has started in the last 3 to 4 months in almost all economies. And that has led to a lot of shakeout. I have a few slides to present, and I think those will cover most of the questions that are there in your mind. And if there are any further questions, I'm sure the Q&A will cover that properly. So, of course, volatility is the order of the day. But I think in India, we have all in the last 3-4 months in the correction have got a bit shaken that, is the India story likely to get derailed? While we look at India, of course, in its isolation, India has fallen by 2% or so in the last 1 year. But if you look at the carnage that has happened in the rest of Asia and the rest of the economies, you'll know that India's strength, it is said that the next decade is going to be of India because of the demography dividend, because of India being one of the fastest growing economies in the world. And it is showing in terms of the strength that we are seeing in our economy. Our 1-year returns are a testimony to that. Not just that, when rupee went from 73 to 80, again, or around close to 80, many of us felt, what's happening, right? Is India going through a crisis? Actually, it's not India going through a crisis. If you look at the rest of the world, if you look at even developed economies like euro, pound, or yen, they have fallen a lot more than the Indian rupee. In fact, on a 1-year basis, Indian rupee has fallen only 6%, while if you look at yen, it has fallen 18%, euro and British pound have fallen 12%. So again, here it is showing the strength of India, wherein we've basically not seen a massive hit on our currency relative to the other, and we've not seen a fall in our markets. The reasons for that will probably ensue when we look at our VCTS framework. We are firmly believers that markets follow valuations, there is a cycle, there is a trigger, and there is a sentiment which impacts market. Let's look at the valuation aspect, because ultimately valuations determine whether you make money in the next year, a few years of your investment. Much like how Manish has explained that on the debt side, that the valuations, because of the interest rates going up in the last 3-4 months by a significant amount, valuations have become cheaper on the debt side. Similarly, on the equity side, we've seen valuation corrections happening. Along with inflation, the corporate profitability has also improved. It is a general trend that in inflationary times, corporate profitability improves because of the prices of goods and services that go up. And that is showing that our long-term P, or let's say our price to earnings ratio, is below the long-term trend. Another indicator, it's also called the buffet indicator, which is market cap to GDP. It's not significantly high. And while we have seen a lot of new insurance companies getting listed, a lot of new age companies getting listed, our market cap to GDP is well within range. And if I have to just give a comparison, when I started my career, our market cap or rather our GDP was about 40 lakh crores. Today it is 250 lakh crores. That's a 17-year history. And when the market cap, when the GDP was 40 lakh crores, our market cap was around 30 lakh crores in India. And today, when the GDP is 250 lakh crores, our market cap has gone to 250 lakh crores approximately. So what is ultimately market cap? It's a function of what the GDP of the economy is, because GDP is nothing but the sale of goods and services by all the entities which are there in the economy. So if the sale of goods and services in the economy is going to improve, that will ultimately lead to the market cap creation and the value of companies going up. And you, by participating in equities, will get the benefit of it. So there is no choice but to participate in equities for the long run, much like how Nimesh has mentioned, 5 years, 10 years, 15 years. The longer you allow your investments to stay in the right places in equities, you will benefit out of it. From a business cycle perspective, we are seeing improvement in credit growth, which has been quite benign over the last 8-10 years, especially after 2013. Our corporate profit to GDP pool had come down significantly. It used to be 8% in 2008, corporate profit to GDP. It came down to as low as 2-3% in the last few years, and now it is improving. So with an increasing inflation, increasing GDP, if the corporate profits also improve as a percentage of GDP, that is good from a business cycle perspective. The one question which obviously keeps coming is, FIIs are selling in India, and why are they selling? Clearly, if you look at FII selling, it's not just in India. While I have not put the numbers across the board, but entire Asia, and if you go back to the performance of the Asian economies which I had shown, all of them have seen selling, and India has also seen selling. But there's one difference. For every penny that the FIIs have sold, and in my 17-year career, I have not seen this kind of selling by FIIs continues for the last 7 to 8 months. It started in October 2021 and it continues till June 2022. It has, and luckily and good for all of us, if we look at the start of July, the selling by FIIs in terms of intensity has become much, much lower. And that gives us confidence that in the near term, we probably may see a bit of relief in terms of FII selling. At the same time, domestic investors, which is mutual funds, have been able to counter punch as far as the FII selling is concerned and counterbalance. If this kind of selling, which we saw in 2008, Nifty ended up falling 50-60%. But with this kind of selling, Nifty has not fallen 50-60%, maybe 10-12%, because of the fact that domestic capital is coming into equities. From 2 crore demat accounts, we have 9 crore demat accounts. And in terms of mutual fund penetration, I think we've seen a brilliant jump in terms of the number of investors who have trusted themselves with mutual funds. and that is reflected in the monthly SIP books. If you look at maybe 8 years back, the SIP book, which is the amount of money which is coming via the systematic investment plan in the mutual funds, was less than about 1,000 crores, maybe even 500 crores. But today, every month, month on month, the number has touched 12,000 crores. So 11 to 12,000 crores of domestic savings coming into the mutual fund equity space through the SIP book. It is a very big positive. And this phenomena is predominantly in India. There is no other country in the world where SIPs are such a large part. And this is steady long-term capital which is flowing into mutual funds and through mutual funds available for the capital creation of India, which is a very important aspect. Are there triggers or are there worries in the world which we should keep a track of? Yes. High crude oil prices because of whatever is happening in terms of the war. We do believe that at some point of time the war will have to ebb. And crude oil prices, which had gone to about $125 a barrel, have already corrected and they are around the $100 a barrel. In fact, in the last 4 months, with all the worry of recession and high inflation, most of the commodities have fallen because of higher interest rates by close to 30-40%. You look at cotton, you look at crude, you look at natural gas, you look at steel, you look at iron ore, across the board, even aluminum, copper, and zinc, they've fallen by 30-40%. And that means eventually, on a year-on-year basis, inflation will look lower, which means from a rising interest rates because of rising inflation phenomena, we may see a bit of, let's say, dovish stance or a lesser worry from a global interest rate hike perspective. And maybe by the time we end this year, the YOY inflation numbers will not look as bad. The hope, of course, is that the war ends as soon as possible so that food and fuel prices also come down. Is the global growth going to slow down? Maybe in US there is a slowdown concern, which is definitely there because when dollar appreciates versus all the other currencies, the corporate revenues in US come down and that basically can create a pain in US. But I do see that with the growing power or the balance, now while US is a large economy, China is also large, India is also growing, Russia by its own is also large. So Asian economies, including Japan, are also quite significantly large. And if they see growth, we can counterbalance whatever slowdown may happen in US, which is good from a 3 to 5 year perspective as far as equities is concerned. And while none of us can predict war, we do believe that wars cannot last forever. So at some point of time, the wars are likely to probably ebb. So from an equity standpoint in inflationary times in a country like India, where for the next 5, 7, 8 years, the growth is likely to be strong, we do believe that investors have choices of investments and the themes which we like the most. I think Nimesh spoke of asset allocation. Manish also in his first slide itself said asset allocation is important. So the schemes which are doing asset allocation on your behalf are and should be the core part of your portfolio and have over the last many years that they've been speaking to you at every point of time said the importance of having dynamic asset allocation funds as part of your category, be it the asset allocator fund or the balance advantage fund. They should be a core allocation for you because like Nimesh mentioned, if you fall less, you need to rise lesser to basically be able to create wealth. And that itself is something which the dynamic asset allocation schemes do very well. So large part of your portfolio in dynamic asset allocation is what we believe. If you remember in his speech, Nimesh mentioned that how it was very difficult to manage funds because you have 30, 40 stocks, but only 10 stocks were doing well. So on this graph, if you look at on the left side, 2018 to 2020, it was practically the show of the top 10 names. Almost the entire returns of the market or the stability of the market was coming from the top 10 names, which grew by 60%. And if you look at the rest of the markets, and especially the mid and small caps, they went through a carnage till September 2020. However, that is changing now since October 2020, and it's become much more diversified in terms of returns, as you can see on the right-hand side, which makes active fund management that much easier. In fact, it makes returns for the investor that much easier because if only the 10 names are running, then probably no matter what you do, you're not able to generate significant returns in the market. So if you look at from that perspective, till at least the interest rates are going up and the world is going to be in a volatile environment for next 2 years, we do believe value will outperform and continue to outperform. So themes like value, special situation, dividend yield should be a part of your portfolio. We all know that India is dependent on crude, and when crude went to $120, it puts a strain on our current account deficit. We are importing a lot more, or we pay a lot more for importing the crude when crude prices go up. And hence, it is very important to have sectors which are generating the dollars which we need to pay for the crude. And that's where a very strong, apart from the remittances that we get, a very strong technology sector, which is the largest in terms of revenue in dollars that we get in India, and a stronger pharma sector is important. So the export opportunity in India is significant, and it is also percolating, thankfully for us, in capital goods, defense, auto. So we are seeing a wider spread in terms of exports, and that is also because if you look at the left-hand side chart, China, in terms of 2005, their labor cost, if you can see the red line, the labor cost in China was minuscule. And if you see today in 2018, the last disclosed number in China, it has gone manifold up. So India is much more competitive today in terms of labor cost compared to China, Brazil, Malaysia, Mexico, Philippines, Vietnam, which are typically our the comparable peers when it comes to if people want to seek imports. Where can they seek imports from? And India, apart from having a very strong domestic economy, also can be a big exporter to the world, which is great from an Indian standpoint. And so we do believe that any theme which invests in exports and services is a good theme for you to be part of for the long run. And another theme, which is consumption. None of us can deny that we are being the second populous country in the world and having a middle class which is going to grow. We are already 52 crore people in the 2,000 to 3,000, 2,000 to $5,000 bracket. That is going to see a further jump in the next 5-6 years. So clearly, consumption and anything to do with consumption across the board. Despite we probably believing that India and economy only at $3 trillion is not meaningful enough, we are the second largest steel, second largest cement producer, fourth largest car market, and so on and so forth. And I can go on and on, but in the interest of time, the core message is anything to do with consumption can be a part of your investment portfolio. To summarize, of course, before I go on the summary, I would also like to say that gold and silver are two commodities in which, while it may have, like Manish had also pointed out, there are times when gold does well, there are times when gold has not done well. Similarly, silver as well. And if we see 2000 to 2010, both gold and silver had a brilliant run. 2011 to 2021, if I can cumulatively say in dollar terms, they've not seen a significant run. So from your allocation standpoint and diversification standpoint, you can also definitely look at systematically adding 5 to 10% gold and silver, depending on what you normally have your asset allocation. And now with the silver ETFs also available and silver fund of funds, that can also be an easy way to invest in silver as a commodity. And it has corrected in the last 6-8 months, providing a reasonably good opportunity to start building a portfolio there of gold and silver. So just to summarize before we open up for Q&A, that valuations in October 2021, when we had touched maybe 18,500 on the Nifty, had become stretched. After the fall and after a year's earnings growth, valuations are not so expensive, neither they are cheap, and hence you need to be very, very, very cautious. At the same time, you cannot stay away from the market. So how you invest, but we do believe you need to start investing, start from the asset allocation bucket, and then move to the themes which we have said. And if you look at from a themes, if any of the themes you like, stagger your investments over the next 8 to 12 months, or depending on whatever you choose and your comfort to make money ultimately in the long run, because 3 years, 5 years, 7 years, it is going to be equities which will generate returns. While in the next 1 or 2 years, debt is also a good asset class, which anyways you will get in the asset allocation schemes that is there. So have a good mix. Do not stay on cash, because in inflationary times, sitting on cash can definitely lead to reduction in your purchasing power over the long run. And markets will bounce back once this inflation fear and recession fears go away. Indian economy, like I said, is going to be strong. And from a concluding remark perspective, your SIPs and your STPs, especially your SIPs, you must have SIPs across the board, and those SIPs should continue for the long run. That's a good way to rupee cost average and make money. So all of you should have SIPs. It's a very good tool to also start inculcating the habit of savings in your children and grandchildren, which probably in India we are seeing receding, because India had a savings rate of 25%, which has come down now to 15%. We are probably going the West way in terms of becoming a consumerist country. But to teach the values of saving, we do believe that all of you should have SIPs as part of your portfolio. With that, I'll stop. I'll hand it over to Komal for the Q&A. Thank you. Komal, over to you.
Thank you, Chintan. Thank you, Manish. That was a very insightful session. While you all were talking, we already have a queue of questions that have come from the audience, and we'll try that in the next 15 minutes or so, we address the queries that we have received. Manish, I'm straight away coming to you, and the question is addressed to you. That today, when the liquid and ultra short term category of funds are giving fairly decent returns, should I continue to park my funds there and wait till the interest rates are peaked out to invest into other debt funds, or the time is to start today?
I think the time has already started for you to look at a 3-year horizon on products other than liquid and ultra short term. Last 1 year, we've been saying that you should protect your capital. Our annual commentaries, both in 2021 January and 2022 January, were very clear that you have to be cautious. But if you look at our valuation indices now, the valuation indices clearly say that it's not a period of caution. It's a moderate period. You have to invest in moderate duration assets, and which is where we think that in this period, you should start to invest in asset classes like credit risk fund and floating rate bond funds.
Manish, I'm taking a cue out of the discussion that I have often with you that why not just give a solution? I think most of the questions from the investors are coming on which fund to invest. But you have a brilliant answer in terms of a solution of a pack of funds that an investor can look at. So if there's 100 rupees that an investor wants to put in a fixed income scheme, can you maybe draw a pen picture for them that what kind of an allocation they can look at from a short term, medium term, and a long term perspective?
Right. So I think if I have to answer it, in one sentence, I have a very easy answer for investors. Like equity, we recommend asset allocation and balance advantage fund to be invested at all points of time. There's no timing for that.
So I have one last question for both of you. Chintan, I'll go with you first. In the current market situation where there's volatility and inflation risk on both sides, which sectors or themes do you think we are bullish on, and how have we built them in our portfolios?
Yeah, so questions get answered easily because I think for every question we've created a fund which can be the solution for the investor. So if you look at the thematic advantage fund of fund, which has been specifically created to portray our views on the themes or the sectors which we like, I think banking as a sector after 8 to 9 years of cleanup of balance sheets, and now with the what I'd shown in terms of the credit cycle also improving or the loan growth cycle improving, is clearly looking as one of the ways of participating in India's growth story. Autos after 3 to 4 years of lull. In fact, if you look at it for 5 years, there has been no significant growth in passenger car sales in India. It's been a stagnant sector. Lockdown played its role as well. Now with the opening up, I think two-wheelers, two-wheelers, three-wheelers, four-wheelers, auto ancillaries, all are probably looking at a better couple of years. So auto, banking, these two sectors look good from a cyclical perspective. I think technology after the recent correction from a bounce perspective with the results is possibly something which can be looked at. Pharma is an evergreen sector. I think all of you must have an SIP in a pharma or the PhD fund from a long-term perspective. From a consumer sector, yes, there are expensive names, but then like I had shown, the consumer is a long-term story. So if I have to restrict it to two names, then banking and auto. If I have to extend it in terms of the defensive basket, then probably pharma and IT would also come in. And infrastructure as a space in India, with the government focus being there, everything to do with infrastructure, be it utilities, be it road construction, all of it should see a better tomorrow because we are significantly deficit in infrastructure. Thank you.
Thank you. Many thanks, Manish, Chintan. That was absolutely a lovely evening with both of you, helping through our investors. For all our investors who are logged in online or watching along with our people, thank you so much for joining us on a Friday evening. My apologies if there are any questions that you had and have not been answered. Please park them with the nearest ICICI Pru AMC team that you see around you or you are in touch with, and we'll have all your questions answered. This was one of our endeavor to help you navigate through these times and help you take some financial decisions. And we'll continue to do such efforts going forward as well. Very happy wealth creation journey from ICICI Pru AMC. Thank you and good evening, everyone.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.